Hey everybody, welcome back to Drawbridge Finance. My name is Levi Woods, and today I want to talk to you about who benefits from making extra mortgage payments, me or the bank. Hey everybody, welcome back. I know I've been away for a while, so I'd like to welcome you to my new home. We've been here for over a month and we've been renovating like crazy, so I haven't had a lot of time to make videos, but I have been thinking about you guys a lot, and I've been thinking about the channel and just thinking about all the great quality videos that I want to make in the future. So today we are going to talk about mortgages, because obviously I bought a new house, so I have a new mortgage, and it was an interesting process because in Canada our interest rates are rising, and what that means is that the banks are a little bit leery about lending out money. They know that they want to qualify people that can afford to make their future payments. And in our case, what they asked us to do was actually make extra payments as part of our regular payment. So they approved us for a rate of 3.4%, but they actually asked us to make payments based on a 3.9% rate. So what that means is that every month we have a couple of $100 extra that we have to pay that goes directly to principal. Now, a lot of people think that this doesn't benefit the bank in any way, because it should benefit the homeowner, the person paying down the loan. Obviously, if you make an extra payment that goes directly to principal, then it's cutting out the amount of interest that the bank will collect over the life of the loan. And especially with a long loan, like a 25-year amortization period, the bank collects a lot of interest. So this really got me thinking about if the bank actually benefits from this or not. I know it is a safety thing for the Canadian banks, because what they're actually doing is collecting more money from us on a monthly basis. So if the rates go up, there's kind of like a buffer, and we can actually tolerate potentially 2 rate hikes to make up that 0.5% difference. And it doesn't affect our payments in any way. So we've pre-qualified for this larger payment. But right when we start the loan, we're actually making principal payments, and that's paying down our loan faster. So in today's video, what I've done is I've created 2 amortization schedules. I'm using our characters Alice and Bob, and we're gonna have fictitious lending companies that they would have. And in both cases, they're gonna do small loans just so the numbers aren't outrageous, but we're gonna look at how those loans get affected by making extra payments. As always, let's take a look at a chart. All right, there's 2 columns. On the left side is Alice's company, and on the right is Bob's company. Both of them are going to do the exact same things. The initial loan that they're going to lend out are worth $1,000 each. The interest that they expect to collect is 5% annually. And we're going to do a term of 300 months or 25 years, which means that for every person that they loan $1,000, the regular monthly mortgage payment is going to be $5.85. Now, both companies are going to be set up in the exact same way. The difference is that Alice is only going to collect $5.85 from each of her customers. Now, Bob, on the other hand, is going to ask for an extra 10%. Now, this 10% that he asks for, on top of the $5.85, is going to be an extra 58 cents, and it is going to go directly to the principal of the $1,000 loan. Now, each of them is going to loan $1,000 to 100 people. So we're going to have a $100,000 initial investment of capital outlay. So both of them are loaning out $100,000 divided by 100 people, or $1,000 each. All right, let's look at how this breaks down. So in the first month, 100 people make a payment of $5.85, and Alice collects $584.59. Now I'm using the exact numbers in here in this spreadsheet because it's easy math for the computer to calculate. So that's the exact payment that she collects. The extra loan payment that she collects is 0. So the amount that Alice's company collects in interest is $416.67. The amount that the customers are paying down their principal by is $167.92. So at the end of the month, she still has 100 loans outstanding, and she has $99,832 in outstanding debt. Her cash balance, the amount that she collected, this $584, is sitting in her account. So she has a $584 cash balance. Now the setup with this is interesting, because when Alice and Bob get that cash balance over $1,000, they're gonna use that $1,000 to lend to a new person, because there's always people that wanna borrow money. So that's the setup of this particular video. Once Alice and Bob have $1,000 bucks, they immediately lend it to somebody else. So let's take a look at Bob. So he collects the same $584, but because he's asked for this extra 10%, he also collects an additional $58. The amount that went to interest is the same as Alice, $416, and the amount paid down to the loan principal is $226 compared to Alice's company, which paid down only $167. So he actually has less money outstanding to the people and therefore collecting less interest going forward. But his cash balance is higher. His cash balance is $643. And this is the interesting part because the cash flow actually changes this scenario dramatically. And you'll see that in the coming months. Let's look at month 4. Because her cash balance in month 2 was actually bumped over $1,100, she was then able to loan to a new person. So she loaned out more money, another $1,000. So now she has 101 customers. She has a greater amount outstanding, and she increases her cash flow in month 4. She now makes $590 instead of $584, which means she collects a little more interest. She gets a little bit more paid down to the loan principal, and the outstanding loans have increased to above $100,000. Now, Bob did the exact same thing. He had $1,286. He loaned to a new person and has now 101 people paying him. His regular loan payments have increased. His extra loan payments have increased as well. So if we go down to month 12, we can see that both of them are collecting the same amount still. Regular loan payment of $607. Alice is collecting $425 in loan interest. She has 104 customers. Bob collects $607, the same as Alice. He's collecting this extra 10% at $60.80. And the loan interest payment is actually lower, $422 compared to the $425 that Alice is collecting. And bigger portion is going to the principal. But that cash flow is going to change over time. So let's scroll down this chart and take a look. And let's take a look at 5 years, just to see. 5 years in, Alice has now got 123 customers and is collecting $719 in her normal payments. $461 is going to interest, and $257 is going to the principal. She has outstanding loans of $110,000. Now, Bob, on the other hand, because he's collecting extra money, greater cash flow, greater portion going back to the outstanding loans. He actually has lower outstanding loans, so which means he's collecting less interest per month. Alice is collecting $461, Bob's collecting $446. Here's the key. Alice only is lending to 123 people. Bob, on the other hand, is loaning to 125 people. This will compound over time. So let's take a look. Let's scroll down, way down this chart. Now remember, after 300 months, they're going to be paid off completely, all of the initial 100 loans. But all of the new people, their loans are continuing. I'm just going to cut to the chase on this, and we're going to see exactly what happens at the very bottom. Let's go to the very last month. So after 252 months, Bob's customers, because they've been making this extra 10% payment, are actually completely 100% paid off at that point. So this is a good point for me to stop and say, okay, here, this is a comparison. After 21 years, how much money have these two people made? One that's collecting just the regular payment compared to a lender that's collecting an extra 10%. Super interesting. So Alice, her regular loan payments, $1,286 per month. The amount going to interest, $471 per month. The amount going to principal, $814 a month. The amount of customers that she has, 221 customers. Outstanding loan balance, $113,000. Now Bob, on the other hand, is collecting $1,356 in payments. He's also collecting $135, way more cash flow. The amount going to the loan interest is lower per month. The amount going to the principal portion is greater, but he has more customers. He has 233 customers. He has 12 more customers than Alice does. Not only has this made his business safer because he has more people to collect money from, but he's actually collecting more revenue. What we also know is that 21 years is a long time. In the business of loaning money, there are interest rate changes. People sell their homes, buy their homes, change their careers, and there's a lot of movement in this. So looking at a static chart, we know that there's going to be a lot of variables, and a lot of the initial loans will not have gone to the full term anyways. And the bottom line is, after all of this, with all of the payments coming in, with Alice's original outlay of $100,000 that she loaned out to people, if she was to call in all of the loans and add up all of the income that she had made over the last 21 years, her total return on investment would be $341,556. Now, Bob, on the other hand, would have made $342,648. Now, comparing this on an annualized basis, Alice's company has made 11.5% per year, and Bob's company has made 11.55%. So Bob has taken less risk and has returned a greater return, and this is why the bank encourages people to make extra payments. Anyways, I hope that wasn't too complex for you guys. I really enjoy all of the feedback that I get from this channel. If you would do me a huge favor, click that thumbs up button down below. I really appreciate it. It really helps my channel. Share this video if you like it, and let's get rich together.